Media Demo.
Welcome to ibbusinessandmanagement.com. I'm Mr. Burton, and today we start the very first of our topics within the accounts and finance topic. So we're looking at the third topic in the IB Business and Management course, accounts and finance. No messing around. Let's get going. 3.1 Sources of Finance. Where do businesses get the funds that they need, the funds that they require? Now, it doesn't matter what business you are, all businesses need funds to finance their business activity, whether that's initial setup costs, day-to-day running of the organisation, or the expansion and growth of the business. Now, to initially set up a business involves not necessarily serious costs, but costs indeed. So setting up a business is going to require startup capital, of cash injections from the owners to purchase essential capital equipment, and possibly the premises. Day-to-day running of the organisation, we know there are expenses there. We know we need cash to pay our staff, our electricity bills, etc., etc. And this is, in essence, financing their working capital needs. So, working capital defined as day-to-day finance needed to pay bills and expenses and to build up the stocks. The stocks are the products that you're going to sell. The stocks of particular goods that we need to produce our final product. Business expansion needs finance to increase the capital assets held by the firm, and often expansion will involve higher working capital needs as well. The bigger your firm gets, the more staff you have to hire, the bigger your wage bills, etc. And also expansion can be achieved by taking over other businesses, and finance is then needed to buy out the owners of the other firm. We have special situations that will often lead to a need for greater finance. Perhaps there's a decline in sales. A lot of firms are experiencing this at the moment in the Great Recession. So a decline in sales could lead to cash needs to keep the business stable, or a large customer could fail to pay for goods, and this could require a large financial hole to be filled quickly. So finance then would be needed to quickly be sought out to pay for essential expenses. And apart from purchasing fixed assets, finance is often used to pay for research and development into new products as well, or to invest in new marketing strategies, such as opening up an overseas market. There are a wide variety of sources and options to fund all sort of business needs. The choice of which sources to use depends on several factors, and these can include and will include the size and type of the business organisation. The bigger the business, the bigger the funds. The larger the funds the business is going to require. The time scale involved and purposes of the finance. For example, a sole trader is likely to use personal finance for setting up the business, whereas a multinational may seek other sources of finance to expand an overseas market. And this is what the unit is all about, examining the range of sources of finance that can be obtained by different types of business organizations, finding the best fit for the business's financing objectives. Okay, we have got capital expenditure. Do get into ibbusinessandmanagement.com again, because a very, very easy, simple, explanatory video there. Now, capital expenditure is the purchase of fixed assets. And fixed assets being defined as items of monetary value which have a long-term function and can be used repeatedly. So land, buildings, machinery, etc. These are things that typically are very expensive, and therefore the sources of finance need to come from medium to long-term sources. Probably the more expensive the asset, the longer the terms of finance will be set up. Medium term, we're talking greater than a year. Long term, I guess we're talking anywhere from 2 to 5 years, even longer than that. Right, once we have got fixed assets purchased, then these can then be used as collateral to leverage other finance. So if we've got a large asset, we've got that paid off, we can use it as security for a bank loan perhaps to leverage other finance. But remember, a fixed asset, a piece of machinery, etc., a building, tends to depreciate over time, which means its value will decline over time. Lower the value, the less it is worth as security by, let's say, a bank. Another type of expenditure that requires business finance is revenue expenditure, and this is just payments for the daily running of the business, so wages, raw materials, etc. If we haven't got sources of finance in place to pay for our staff, we're going to lose our staff and we're going to lose our business. Sources of finance can come from internal or external sources. Internal meaning obviously coming from within the business. And we have got a variety of internal sources that we can use. Personal funds, the owner putting in his or her own money into the business. Family and friends, tapping your family, tapping your friends. Come on, invest in my business. It's great. The returns will be huge. Working capital, this is just cash that builds up through the typical day-to-day running of the business. So if sales are greater than the costs of the day-to-day running of the business is going to accumulate cash on hand. So working capital can be a source of finance as well. Retained profits, revenues greater than expenses. Suddenly we have made a profit, and this profit can be ploughed back into the business for whatever reason. Selling assets is another option for raising funds. Assets the business owns, therefore it is internal. Make sure you know and can explain retained profits, working capital, important terms to be able to define as you're answering questions in the exam. Which must bring us to external sources of finance. Now these are huge. There are a wide variety of sources, and we define them as coming from outside the business. Look at these massive variety of different sources, external sources that a business can use. Share capital, loan capital, overdrafts, trade credit, government grants, donations, sponsorships, debt factoring, venture capital, business angels, bonds, debentures, leasing and hire purchase. A whole host of different external sources of finance that are open to the business. The terms in pink, share capital, loan capital, overdrafts, trade credit, etc., are the important definitions to know and be able to throw down, again, in exam conditions. Make sure you visit ibmanagement.com for the appropriate definitions, or any good IB business and management textbook as well. Time frames for finance are an important component as well, external finance that is. We have got short term, and we define the short term as being the current financial year. So we will need to repay creditors and lenders within 12 months if it's to be considered short term. Medium term, more than 12 months and less than 5 years. So the medium term finance must link with medium term plans, aims and objectives of the business. An example here would be commercial loans, bank loans and hire purchase agreements. Long term, obviously anything greater than 5 years. Now, with such a long term time horizon, it's going to be more and more difficult for managers to think about their financial needs this far ahead. 5 years is a long time in business speak. Right, now sources of finance is part of business strategy. A lot of business failure is largely caused by a lack of financial planning. You've all heard and seen the statistics. 50% of businesses failing within a year. So managers have to consider a large number of interlinked factors when deciding on alternative sources of finance. We need to consider the purpose, the cost, the amount, external factors out there, financial situation of the firm, the status and the size of the firm, and the time that we are looking at. And let's quickly run through a few of these. We'll start with purpose of finance. So will the source of finance be used for short-term purposes, for the day-to-day running of the business, or for the replacement of fixed assets over a longer time? Overdrafts, for example, will be more suitable for improving working capital, whereas hire purchase may be more suitable for buying expensive equipment. Cost. Managers will need to consider not only the purchase cost of assets, but the associated costs such as administrative charges, service and maintenance charges, and short and long-term consideration of interest rates. As with most business decision-making, managers also need to bear in mind the opportunity cost of their financial choice, and you need to bear that in mind as well. Any decision, any finance decision, any source of finance decision will have an opportunity cost. The amount required. Large amounts of finance might be raised through share issues or through secured loans from financial institutions. These can be financed by paying the lender in regular instalments to spread the high cost of finance. If only a small amount is needed, perhaps for dealing with short-term liquidity problems, then an overdraft might be sufficient. Time. If the finance is needed for a long period, such as the purchase of new buildings, long-term sources of finance, such as mortgages or debentures, are suitable. If the finance is needed to help fund working capital, short-term sources such as trade credit will be more appropriate. If this terminology is getting a bit much, trade credit, overdrafts, liquidity, etc., stop what you're doing now, go and look at the flashcards on ibbusinessandmanagement.com and get familiar with the terminology. Status and size of the firm. A well-known and large multinational corporation will find it much easier to raise finance from a wider range of sources than a sole trader. Financial situation of a firm. Businesses with poor cash flow will find it more difficult to raise finance as they represent a higher risk to investors and lenders. In addition, lenders will access the existing gearing. Now, don't worry too much about gearing. We're going to hit that later on in this accounts and finance section. Now, firms with a high gearing ratio represent a relatively high risk as they have existing debt commitments and are more vulnerable to any increase in interest rates. And any increase in interest rates is going to raise their interest repayments to banks. Lenders will be aware that any increase in short-term liabilities will reduce working capital as well. And the various external factors that might need considering as well. And these are factors beyond the control of a business that may have a huge impact on the choice and availability of finance. Managers will be affected by the state of the economy and business confidence levels. Investments for expansion plans are more likely to take place during prosperous economic time. Changes in interest rates and stock market volatility also affect the level of consumer and producer confidence levels, which thereby affect the level of business investments. And also, during this great financial crisis, worldwide we've seen interest rates drop across the board. It is very, very, very cheap to borrow at the moment, but difficult to find a bank that is willing to lend in these uncertain times. A bit of a catch-2 situation. Now, a common exam question is, a really common exam question actually, is to be able to evaluate different sources or options.